Financial markets may appear chaotic on the surface, but beneath the constant movement of prices lies a structured environment shaped by different types of participants, varying objectives, and the continuous search for liquidity. To understand why prices behave the way they do, it is important to first understand how modern markets are structured and who is involved in them. Many traders focus only on charts and indicators, but the true forces behind price movement often come from the interaction between the participants operating within the market. One of the most fundamental aspects of market structure is the presence of different types of participants. Financial markets are not dominated by a single group of traders. Instead, they consist of institutions, hedge funds, investment banks, proprietary trading firms, algorithmic systems, and individual retail traders. Each of these participants operates with different resources, strategies, and time horizons. Large institutions typically manage significant amounts of capital and rely on advanced technology, research teams, and sophisticated trading systems. Their primary goal is often to move large volumes of capital efficiently while minimizing market impact. On the other hand, individual retail traders usually operate with smaller capital, limited technological tools, and shorter-term decision-making processes. These differences in scale and capability naturally create an imbalance in how participants interact with the market. Because institutions trade much larger volumes, they cannot simply enter or exit positions instantly without affecting price. Executing large orders requires careful planning and access to sufficient liquidity. This is where the concept of liquidity becomes central to understanding market behavior. Liquidity refers to the availability of buyers and sellers at different price levels. In a highly liquid market, orders can be executed quickly without causing significant price movement. In contrast, low liquidity can cause prices to move rapidly because there are not enough orders available to absorb incoming trades. For large market participants, liquidity is essential. When institutions want to execute large orders, they must locate areas where enough opposing orders exist to absorb their trades. Because of this requirement, liquidity tends to accumulate around certain predictable areas within the market. These areas often include well-known technical levels such as support and resistance zones, previous highs and lows, and areas where traders commonly place stop-loss orders. These levels become important not just because they appear on charts, but because they represent locations where many market participants are likely to place orders. When price approaches these levels, the market often experiences increased activity. This happens because different participants react to the same levels in different ways. Some traders may be entering new positions, others may be closing existing trades, and many stop-loss orders may be triggered simultaneously. The combination of these orders creates concentrated liquidity, which attracts larger market participants looking for efficient trade execution. This dynamic explains why prices often move toward liquidity. Markets naturally gravitate toward areas where orders are concentrated, because those areas provide the necessary conditions for large transactions to occur. When price approaches a liquidity-rich zone, it may initially slow down as buyers and sellers interact. However, once certain levels are breached, price movements can accelerate rapidly. For example, when price reaches a level where many stop-loss orders are placed, triggering those orders can create a surge of market activity. Stop-loss orders often convert into market orders when activated, meaning they execute immediately at the next available price. If a large cluster of stop-loss orders is triggered at once, this can create strong momentum in one direction, causing price to move quickly through the level. From the perspective of retail traders, these movements can sometimes appear confusing or even unfair. Many individual traders rely on similar technical tools when analyzing charts. Concepts such as support and resistance, trend lines, and breakout levels are widely taught and commonly used across the trading community. As a result, many retail traders place their orders in similar locations. Stop-loss orders, in particular, tend to cluster around predictable areas. Traders often place them slightly below support levels, slightly above resistance levels, or just beyond recent highs and lows. While this approach is logical from an individual risk management perspective, it also creates clusters of orders that become visible within the broader market structure. When many traders place their stop-loss orders in the same locations, those areas effectively become liquidity zones. Large participants seeking to execute significant trades may naturally gravitate toward these zones because they provide the liquidity needed to fill large positions. As price approaches these levels, the triggering of clustered orders can contribute to rapid price movement. This interaction between retail order placement and institutional liquidity needs can create price patterns that sometimes appear unusual or unexpected. For example, price may briefly move beyond a well-known support or resistance level before reversing direction. To many retail traders, this may feel like the market intentionally moved against them. In reality, such movements are often the result of liquidity dynamics rather than deliberate targeting. Understanding this structure provides a deeper perspective on how markets function. Price movements are not purely random, nor are they driven solely by technical patterns on a chart. Instead, they are shaped by the distribution of orders and the constant search for liquidity by market participants of different sizes and objectives. The core insight is that market behavior is heavily influenced by liquidity distribution. When many traders place orders in predictable locations, those locations naturally become areas of concentrated liquidity. Price movements often interact with these areas because they provide the conditions necessary for large trades to occur efficiently. By understanding how liquidity dynamics influence market behavior, traders gain a more realistic perspective on why price sometimes behaves in unexpected ways. Rather than viewing unusual price movements as random events, they can begin to see them as part of the broader interaction between different market participants operating within a complex but structured financial system. To understand many unusual price movements in financial markets, it is important to examine how retail traders behave. Individual traders often rely on similar educational resources, trading strategies, and technical analysis tools. While these methods are useful for understanding market structure, they can also create patterns of behavior that become highly predictable. When a large number of traders make decisions in similar ways, their collective actions begin to form clusters of orders within the market. These clusters can influence how price behaves around certain levels. One of the primary reasons retail traders become predictable is the widespread use of common technical strategies. Technical analysis is widely taught through books, courses, online content, and trading communities. As a result, many traders learn to analyze the market using similar concepts and frameworks. Some of the most popular approaches include breakout trading, support and resistance trading, and trend continuation setups. Breakout trading is based on the idea that when price breaks above resistance or below support, it may continue moving strongly in that direction. Traders using this strategy often wait for price to move beyond a key level and then enter a position expecting momentum to follow. Similarly, support and resistance trading focuses on buying near support levels and selling near resistance levels, assuming that price will react or reverse at those points. Trend continuation setups are another widely used method. In trending markets, traders look for pullbacks or consolidation areas where they can enter positions in the direction of the existing trend. These setups typically involve waiting for confirmation signals such as candlestick patterns, moving average interactions, or momentum indicators. While these strategies are logical and widely accepted, their popularity creates an important side effect. Because so many traders follow similar methods, they often focus on the same price levels when making decisions. This leads to predictable entry points within the market. For example, when price approaches a clearly defined resistance level, many traders watching the chart will be waiting for a breakout. As soon as price moves slightly above that level, a large number of breakout traders may enter long positions simultaneously. Confirmation signals such as strong candles or increasing volume can further reinforce this behavior, encouraging even more traders to participate in the breakout. When multiple traders enter positions at nearly the same price level, the market experiences a sudden increase in order concentration. Instead of orders being spread evenly across different price levels, they become clustered around specific points. This clustering effect creates pockets of liquidity within the market where a large number of orders are waiting to be executed. Predictability also appears in the way traders manage risk through stop-loss placement. Stop-loss orders are essential tools used to limit potential losses if a trade moves in the wrong direction. However, because many traders rely on similar technical structures, they often place their stop loss orders in nearly identical locations. One of the most common practices is placing stop-loss orders just below support levels when entering long trades. The reasoning behind this approach is simple. If price falls below support, it may indicate that the level has failed and the trade idea is no longer valid. Similarly, traders who enter short positions near resistance often place their stop-loss orders slightly above the resistance level. Another common stop-loss placement occurs near recent highs or lows. Traders frequently assume that if price moves beyond these recent extremes, the market may continue further in that direction. Therefore, placing stops just beyond these levels appears to provide logical protection against unfavorable price movement. Although these practices are individually rational, their widespread use leads to predictable patterns in order placement. When thousands of traders place stop-loss orders near the same levels, those areas become highly concentrated zones of liquidity. These zones contain a large number of orders that will be triggered if price reaches them. Understanding why predictability matters requires recognizing how liquidity functions within financial markets. Liquidity pools form wherever large groups of orders are located. These pools represent areas where significant trading activity can occur because many participants are prepared to buy or sell at those levels. Large market participants, such as institutions and funds, often require significant liquidity to execute large orders efficiently. If a market participant wants to trade a very large position, it cannot always be executed instantly without causing large price movements. As a result, areas with concentrated liquidity become important because they allow larger trades to be absorbed by the market more smoothly. When clusters of stop-loss orders or breakout entries accumulate around specific price levels, they effectively create liquidity pools. These pools can attract price movement because they represent areas where many orders are waiting to be activated. When price approaches these zones, the triggering of multiple orders can generate strong bursts of activity. This dynamic often leads to recognizable market behavior. One common pattern involves sudden spikes beyond key technical levels. Price may briefly move above a resistance level or below a support level, triggering a wave of breakout entries and stop-loss orders. Once these orders are activated, the surge of market activity can push price further in that direction for a short period. However, these movements do not always lead to sustained trends. In some cases, after the cluster of orders has been triggered, price may quickly reverse back into its previous range. This type of movement can feel frustrating for traders whose stop-loss orders were just triggered before the reversal occurred. Another possible outcome is that price continues moving in its original direction after briefly triggering the liquidity pool. The initial spike may create enough momentum to allow the broader trend to resume, especially if additional market participants join the movement. In both cases, the key factor influencing these behaviors is the concentration of orders created by predictable trading patterns. When many traders rely on the same technical structures and place their entries and stop losses in similar locations, the market naturally forms clusters of liquidity around those levels. Understanding how retail traders become predictable provides valuable insight into the mechanics of market movement. Instead of viewing unusual price spikes or sudden reversals as random events, traders can begin to see them as the natural result of collective behavior within the market. Recognizing these dynamics can help traders interpret price movements more clearly and develop a deeper understanding of how liquidity influences market structure. To understand many sudden price movements in financial markets, traders must become familiar with the concept known as a liquidity sweep. While price charts often appear unpredictable, many short-term movements follow identifiable patterns related to the way liquidity is distributed across the market. A liquidity sweep refers to a situation where price briefly moves beyond a key level, such as support, resistance, or a recent high or low, before reversing direction. This movement often occurs because the market is accessing clusters of orders that have accumulated in predictable areas. At its core, a liquidity sweep is a short-term move beyond an important price level that triggers a large number of stop-loss orders or pending entries placed by traders. Because many retail traders place their stop losses in similar locations, these orders tend to cluster around obvious technical levels. When price reaches these areas, the triggering of multiple stop orders can create a surge of activity in the market. After these orders are activated and absorbed, price may reverse and move in the opposite direction. For traders who are not familiar with this concept, liquidity sweeps can appear confusing or frustrating. A trader might see price break above a resistance level, assume that a strong breakout is occurring, and enter a long position. Shortly afterward, the market reverses sharply and moves downward, stopping out the position. To the trader, it may seem as though the market intentionally moved against them. In reality, this type of movement is often related to how liquidity functions within the market. Liquidity sweeps occur primarily because large market participants require access to sufficient liquidity when entering or exiting positions. Institutions, funds, and other large traders often manage positions that are significantly larger than those of individual retail traders. Because of the size of their trades, they cannot always execute orders instantly without influencing the market price. When a very large order is placed in a market with limited liquidity, it can push price dramatically in one direction. To avoid this problem, large participants often look for areas where many opposing orders are available. These areas allow large trades to be absorbed more efficiently without creating excessive price disruption. Clusters of stop-loss orders represent one of the most accessible sources of liquidity. When traders place stop-loss orders around predictable technical levels, they create pockets of potential market activity. Once price reaches these areas, the stop-loss orders are triggered and converted into market orders, which must be executed immediately at the best available price. Because stop orders become active market orders once triggered, they create immediate buying or selling pressure, depending on the direction of the trade. This sudden surge of orders provides liquidity that larger participants can use to enter or exit their positions. As a result, price may temporarily move beyond a key level in order to trigger these orders and access the available liquidity. This process leads to several common market patterns that traders often observe. One of the most recognizable patterns is the false breakout. In a false breakout, price moves beyond a support or resistance level that many traders are watching. Breakout traders may enter positions expecting continued momentum in the direction of the breakout. However, shortly after the move occurs, price reverses and returns back within the previous range. Another pattern associated with liquidity sweeps is what traders sometimes describe as a stop-loss hunt. In these situations, price briefly moves into areas where many stop-loss orders are located before reversing direction. While the phrase stop-loss hunt can sometimes imply intentional targeting, the underlying mechanism is often related to liquidity dynamics rather than deliberate manipulation. Markets simply move toward areas where large clusters of orders exist. Quick spikes followed by sharp reversals are also common signs of liquidity sweeps. These movements typically occur very quickly, sometimes within a single candle or a short sequence of rapid price changes. Traders watching the market may see price suddenly surge beyond a key level and then immediately reverse direction once the available liquidity has been absorbed. After the liquidity has been collected, market behavior often changes. Once the cluster of stop-loss orders has been triggered and absorbed by larger participants, price may stabilize. With the excess orders removed from the market, the environment becomes more balanced between buyers and sellers. At this stage, the market frequently resumes its original trend direction. For example, in an uptrend, price might briefly drop below a recent support level to trigger stop-loss orders from long positions. Once those orders are activated and absorbed, buying pressure may return, allowing the market to continue moving upward. Momentum can build again after liquidity has been collected because the market no longer faces the same concentration of opposing orders. In many cases, the removal of clustered stop orders actually clears the path for price to move more freely in the dominant direction. One reason these patterns continue to appear in financial markets is the consistency of retail trading behavior. Most traders learn technical analysis using similar concepts and tools. Support and resistance levels, breakout strategies, and stop-loss placement near obvious technical zones remain widely used across the trading community. Because traders repeatedly place orders around these same levels, liquidity clusters continue to form in predictable locations. As long as this behavior remains consistent, the market will continue interacting with these liquidity pools in similar ways. Understanding the mechanics of liquidity sweeps provides traders with a deeper perspective on price behavior. Instead of viewing sudden spikes or reversals as random events, traders can begin recognizing the role that liquidity plays in shaping short-term market movements. This awareness allows traders to interpret price action more clearly and develop a more informed approach to analyzing market structure. Understanding liquidity sweeps is valuable, but the real advantage comes from learning how to recognize potential liquidity traps while the market is actually moving. Many traders only understand these patterns after the move has already happened. However, by developing awareness of certain signals and behaviors, it becomes possible to identify situations where the market may be interacting with liquidity zones rather than starting a genuine trend. This awareness helps traders avoid unnecessary losses and make more thoughtful trading decisions. One of the most common signs of a potential liquidity trap is a sudden spike beyond a well-known support or resistance level. These levels are often watched by a large number of traders because they represent obvious areas where price has reacted in the past. When price approaches such a level, many traders prepare for a breakout. If price suddenly moves beyond that level with strong momentum, it may initially appear that the market is beginning a new trend. However, in some cases this breakout is short-lived. Instead of continuing in the same direction, price quickly reverses and moves back inside the previous range. This rapid shift can signal that the breakout was primarily driven by the triggering of clustered orders rather than sustained buying or selling pressure. Another important signal is rapid price movement followed by an equally rapid reversal. Liquidity sweeps often occur very quickly because once a key level is breached, multiple stop-loss orders and breakout entries can be triggered simultaneously. This sudden surge of orders creates sharp volatility in the market. If the move lacks strong follow-through after the initial spike, it may indicate that the market has already collected the liquidity it needed. High volatility around breakout zones can also be a warning sign. When price repeatedly moves above and below a key level within a short period of time, it suggests that the market is struggling to establish clear direction. In these situations, traders who react too quickly may find themselves entering trades just as the market reverses. Market timing also plays an important role in liquidity sweeps. Financial markets do not behave the same way at all times of the day. Certain periods are known for higher trading activity, such as major session openings or times when multiple global markets overlap. During these periods, liquidity increases and price movements can become more aggressive. Liquidity sweeps often occur during these high-activity sessions because the increased participation provides the necessary volume for large movements. When more traders are active, more stop orders and breakout entries are likely to be triggered around important price levels. This creates conditions where rapid price spikes and reversals are more likely to appear. News events can also intensify these movements. Economic announcements, interest rate decisions, or unexpected global developments can introduce sudden volatility into the market. When important news is released, price may move rapidly through multiple levels in a short period of time. These movements can trigger clusters of stop-loss orders and create the appearance of a breakout even if the broader market direction remains unchanged. Because of these factors, volatility often increases the probability of liquidity clusters being activated. Traders who understand this relationship are less likely to react impulsively during fast market conditions. Avoiding reactive trading is one of the most important skills in navigating these situations. Many traders feel pressure to enter the market immediately after a breakout occurs. The fear of missing out on a potential trend can lead to rushed decisions. Unfortunately, entering trades immediately after price breaks a key level can expose traders to liquidity traps, especially if the breakout lacks strong confirmation. Waiting for additional confirmation can significantly reduce this risk. Instead of reacting instantly, traders can observe how price behaves after the breakout. If price continues moving steadily in the same direction and begins forming new structure above or below the level, the breakout may be genuine. However, if price quickly returns to the previous range, it may indicate that the move was simply a liquidity sweep. Observing price behavior after a breakout provides valuable information about the strength of the movement. Markets that truly intend to trend usually maintain momentum rather than reversing immediately. By taking a more patient approach, traders improve the quality of their decisions and avoid many false signals. Patience is therefore an essential component of effective market participation. Not every breakout represents a meaningful opportunity. Many price movements are temporary reactions to liquidity rather than the beginning of a sustained trend. Traders who wait for the market structure to stabilize often find better entry points with lower risk. When the market settles after a volatile move, clearer patterns begin to form. Price may establish new support or resistance levels, or it may confirm the continuation of an existing trend. Entering trades during these more stable conditions often leads to better outcomes compared to chasing fast, moving breakouts. Controlled participation also helps reduce unnecessary losses. By selecting trades carefully and avoiding impulsive entries, traders can focus on opportunities where the market structure is clearer and more aligned with their strategy. Developing strong market awareness is the final step in recognizing liquidity traps. Over time, traders who observe charts regularly begin to notice recurring patterns across different markets and timeframes. Sudden spikes beyond key levels, rapid reversals, and volatility around major zones often repeat themselves because trader behavior remains relatively consistent. By studying these patterns, traders can begin identifying areas where liquidity is likely to be concentrated. These areas often include recent highs and lows, major support and resistance levels, and zones where many traders typically place stop-loss orders. Integrating liquidity awareness into trading analysis does not replace traditional technical analysis. Instead, it adds an additional layer of understanding. When traders combine technical structure with an awareness of where liquidity may exist, they gain a clearer perspective on why the market moves the way it does. Over time, this perspective helps traders avoid common traps, remain patient during volatile conditions, and make more informed decisions when participating in financial markets. As traders develop a deeper understanding of liquidity dynamics, their perspective on the market often begins to change. Instead of viewing price movements purely through the lens of traditional technical patterns, they begin recognizing that many movements are influenced by the interaction between different market participants and the constant search for liquidity. Adapting to this reality requires adjustments in how traders interpret breakouts, manage entries, control risk, and study market behavior over time. One of the first adjustments involves changing the way breakouts are interpreted. Many traders are taught that when price breaks above resistance or below support, it signals the start of a strong directional move. While this can sometimes be true, traders who understand liquidity dynamics also recognize that breakouts can serve another purpose. In many cases, a breakout may represent a liquidity event rather than a genuine shift in market direction. When price moves beyond a well-known level, it can trigger clusters of stop-loss orders and breakout entries that have accumulated around that level. This sudden surge of orders provides liquidity for larger participants. As a result, traders should approach breakouts with a balanced perspective. Instead of assuming that every breakout will lead to a trend, it becomes important to analyze the surrounding market structure and consider the possibility that the move could be temporary. Improving entry timing is another key aspect of adapting to liquidity-driven markets. Many losses occur when traders enter positions immediately after a rapid price movement. Volatility spikes can create the illusion of strong momentum, encouraging traders to react quickly. However, these moments often represent the exact conditions where liquidity sweeps occur. Waiting for confirmation after volatility spikes can significantly improve entry quality. When traders allow price to stabilize and observe how the market behaves after a sudden move, they gain more information about the true direction of the market. If price continues moving consistently in one direction and forms stable structure, the movement may be genuine. If it quickly reverses or becomes unstable, it may indicate that the move was primarily driven by liquidity collection. Allowing the market to settle before entering positions reduces exposure to sudden reversals. This approach requires patience, but it often leads to more reliable trade setups and fewer impulsive decisions. Risk management also becomes especially important in liquidity-driven environments. Traders who place stop-loss orders extremely close to obvious technical levels may find that they are frequently stopped out during short-term volatility. While stop-loss orders are essential for protecting capital, placing them in highly predictable locations can expose traders to unnecessary risk. Instead of relying on overly tight stops, Traders can focus on managing position sizes carefully so that their risk remains controlled, even if the stop-loss needs to be placed at a more practical distance. Proper position sizing ensures that no single trade can significantly damage the account. At the same time, traders must accept that uncertainty is an inherent part of financial markets. Even with strong analysis and disciplined risk management, no trade is guaranteed to succeed. Recognizing this reality helps traders remain calm and focused on their long-term process rather than reacting emotionally to individual outcomes. Developing long-term market understanding is also essential for adapting successfully. Liquidity-driven patterns often repeat themselves across different markets and timeframes. By studying charts regularly and observing how price behaves around key levels, traders can begin recognizing these patterns more clearly. Over time, this observation helps traders understand how liquidity shapes market structure. They begin to notice where clusters of orders are likely to exist and how the market interacts with those areas. This deeper awareness gradually improves analytical skills and decision-making ability. Ultimately, financial markets are driven by the interaction of many different participants, each operating with their own objectives and strategies. Liquidity acts as the mechanism that connects these participants and allows trades to occur efficiently. Understanding the role of liquidity does not eliminate uncertainty, but it provides traders with a more realistic framework for interpreting price movements. By adapting their perspective, improving entry timing, applying disciplined risk management, and continuously studying market behavior, traders can navigate liquidity-driven markets with greater clarity and confidence.